Assalamu alaikum. Hello, how are you? This is the last topic under section A, which is financial management function. We are going to talk about non-profit organization here, how they set objectives, how they are different from the profit organizations and all. This is a short video, right? So what is objective setting in not NFP, not for profit organization? So the primary objective here is not to make profit, right? It is for the benefit of society. Next, because it does not have a specific objective like how we had in the private sector, which was wealth maximization, shareholders wealth maximization. Here we don't have a specific objective, so that's why it's difficult to quantify because most of it are non-financial objectives. For example, quality of care given to patients in hospital, you might want to increase that quality. So how do you measure that quality that you are giving to the patient, right? It's difficult to measure in terms of financial terms. It's difficult to quantify such objectives. Therefore, objective setting in not-for-profit organization is more harder and complex than profit organization. Next, multiple and conflicting objectives are common. Yes, here we have multiple objectives and they might conflict with each other. For example, quality of patient care versus number of patients treated. Let's say if your objective is to increase the number of patients treated, then the quality which you give for each patient might, it might suffer because you cannot give that high quality if you want to increase the number of patients. Next, wide range of stakeholders. When you set objectives, you have to see that with these are some few of the factors which influences the objective setting. One is it has a wide range of stakeholders, not like profit organizations where you have to just focus on certain stakeholders. But here, wide range of stakeholders. You have to care about society. You have to care about the customer, everyone, the government, the one who gives the tax. Next, we have high level of interest from stakeholder groups. In not-for-profit organization, there's a very high level of interest from the stakeholder groups. It could be charity, it could be NGOs, it could be government, it could be the community group, it could be the pressure group. Next, significant degree of involvement from funding bodies and sponsors and funding bodies. How do they collect the money if profit is not their objective, right? Definitely they have to go for some donation, someone is going to donate, that's how they raise money, through sponsors and all. So significant degrees involved here. Next, we have little or no financial input from the ultimate recipient of the service. The one who's going to get that service, they are not going to give anything. They're going to give it free of cost, right? Next, projects typically have a longer term planning horizon. Yes, for example, the government want to construct a hospital. So that project is usually for a long term planning horizon, right? Next, we have maybe subject to government influence and government macroeconomic policy. Next, section B is whole about this government macroeconomic policy only. How they set interest, their tax, how government is going to spend, how they are going to influence the demand and the supply. All we are going to learn in section B, which is known as financial management environment, right? Environment background. Next, value for money and three E's. What are these three E's and what is this value for money? You have to know this in non-for-profit organizations. First of all, let's define what is value for money. Value for money can be defined as what? Achieving the desired level and the quality of service at the most economical cost. Whenever the definitions are given there, you have to be very careful with the definitions because you might get in the multiple choice questions. So you have to select one, the best one. So make sure that each word is there. Desired level, quality of service, economical cost. Okay, next. What is this three E's? First E stands for economy. Economy means minimizing the cost of input required to achieve a defined level of output. The cost is minimized, right? You're using less input to achieve the maximum output. That is known as economy. Next is efficiency. That is your output to input, right? So economy is about minimizing cost. Efficiency is how much input you're using to get the output. You're trying to use less input to get the maximum output. Okay, so achieving a high level of output in relation to the resources put in, input driven or providing a particular level of service at a reasonable input cost. First one is you want to achieve a high level of output with low level of input, that is known as input driven. If you want to give a particular level of service but at a reasonable input cost, not low cost, reasonable input cost, that is output driven. You care about the output more than the input. That's why it's output driven. Next, the third E, effectiveness. You have to remember all the three E's: economic efficiency and effectiveness. Effectiveness means whether outputs are achieved or not, that match the predetermined objectives. In short, whether your objective has been met or not. Next, there are key financial objectives for NFS. NFPs. What is it? Not-for-profit organizations will be available to number one, raise as large a sum as possible. That is one of the objectives. The other one is spend fund as effectively as possible. These are the two key financial objectives. Next, we have a diagram where you can clearly understand how we are going to focus on each one. So they say that a business is made up of a system. Every business operates in this system. They have input, they have the process, then they have output and outcome. Okay. So how are you going to assess whether the organization provides the value for money or not? You have to look at their functions in the organization. And you have to evaluate each part separately. Let's say, for example, you want to evaluate the economic aspect. Okay, out of the three is the economy. You want to evaluate. Look at the input. Okay, input could be your material, your staff, your cash, because it focuses on cost control, cost control. How much can you control the cost? Can you get your materials at a lower cost? Can you get your staff at a lower cost? Can you know all these things you have to see. Next, your process. How well you are converting your input into output. Using your material, staff and cash, how well you are converting it into goods and services. That is efficiency. Okay, the process could be your interaction of people, structure, information and task requirement. It talks about methods and system. Next, we have outcomes. The outcome is effectiveness. It focuses on effectiveness. Meeting the plan objectives. Definitely this diagram is not required. You don't have to. It's just for your understanding purpose. That economy is about the cost. Efficiency is about systems and methods. Effectiveness is about targets. Achieving target. Next, targets for non-profit organization. What is it? Number one, total to be raised in grants and voluntary income. This could be some of the targets, because we know that non-profit organization, not-for-profit organization receives grants and subsidy from government, so they want to raise it. And voluntary income. Next, we have maximum percentage of this total that fundraising expenses represent. Okay, next we have amount to be spent on specified projects or in a particular area. You want to have set a target. What is the amount you want to spend on a specific project? Maximum permitted administration cost. How much of the administrative cost is permitted? What is the maximum? We have meeting budgets. Budgets, it's all about budget. They have a budget, we have to meet that budget. In the public sector, then we have breaking even in the long run. So since this is not profit making organization, so their main objective is also not profit making. They just want to somehow, they don't want to go loss also. Okay, they don't want to operate either at a loss, so break even, where profit and loss are equal. Next, this is the summary, like, okay, I have zoomed it for you so that you can see. So we are done with it, section 7, and this is the overall from 1 to 7. All the videos from part 1 to 7 is here in this. It is summarized. Okay, so this is for your summarization. Financial management broken down into nature and purpose of financial management. So if you see in the nature and purpose, it is setting financial objectives, deciding on proposed investment, funding sources, distribution of earnings, controlling resources, managing risk. Next, we have compare. Compare what? Management accounting and financial accounting with financial management. Financial accounting is historical summaries. Management accounting is day-to-day information. Next, we have relationship between corporate and strategy objectives. What is it? So the corporate objective is broken down to business objective. It is further broken down into operation objective. So for corporate objective, it will be corporate strategy. Business objective will be achieved through business strategy. Operation objective, operational strategy. Simple. Developing the financial, the third branch, developing the financial objective. So if you see, what are the financial objective? Maximizing and satisfying, we learn the difference. Maximizing, maximum. Satisfying, you are satisfied with that level. It's neither maximum nor minimum. Okay, it is something which has satisfied, you are satisfied with it. EPS growth. It is common objective, but still it is based on profits. Profit maximization. Okay, it focuses on short-term gain. Shareholders might sometimes be unconvinced, and shareholder wealth maximization. Main objective of financial management is this one only. Right. So the next one. On the next page, we come to management and stakeholder objective. Under this, let me zoom out a bit for you. So the stakeholder and the role of management. First, we are going to study through the stakeholder. We have studied stakeholder. If you haven't watched my previous video, by the way, it's out. You can go and watch it. Okay. Where we have explained all stakeholder, the conflict, how it is solved, the agency theory, how it is solved by different methods. So stakeholder. Who are the stakeholders? The one who have interest in the company. What are the objectives? Different. Each stakeholder objectives might be different. We have gone through those. And the conflict, where management might have different objective compared to shareholder. Next branch is the role of management. So management they act as an agent, okay, on behalf of the shareholder. Shareholders are the principal. So that's why we have this agency theory. Okay, how are we going to solve the agency issues? Where their objectives are not aligned. We have remuneration packages, we have corporate governance code. Remuneration packages, we can earn the earnings to the return, or we have share option scheme. Okay, and then we have corporate governance code where we talked about non-executive director and executive director, how they are going to be appointed, what are their roles, how they deal with shareholders and all. Basically guidance on directors. So next we have this objectives in not-for-profit organization, which is this video is about it. So we have examples also, such as charities, public services, local government, and etc. Then we have the impact. What is the impact? Right? Wide-ranging stakeholders, involvement of sponsor, no price. Okay, no one pays a price for it. And what are the impact on the financial objectives? So limited funds. So the targets would be total to be raised, amount spent on fundraising, amount to be spent on specified projects, administration spending, stay in budget, break even, understanding value for money. Okay, we have explained what is value for money. Okay, achieving the desired outcome or level at the quality of service at most economical cost. So what is the 3 E's? How do you measure the value for money using the 3 E's? What does it stand for? Economic efficiency and effectiveness. So we know what is economy, low cost, efficiency, using the systems, and effectiveness, meeting the objective, the outcome, and setting objectives. So we set the objectives or targets in each of the 3 A's for economic efficiency and effectiveness. Next, that's it. And the next is we are moving on to section B, which is the financial management, the business environment. We are going to talk about macroeconomic policies. That is our next topic on that. And before I go to macroeconomic policy, we are going to cover the questions from revision kit on section A. All the questions. So thank you for watching and see you in my next video.